Welcome to the CFA Society Ottawa Summer Webinar Series. My name is Sean Kulik and I'm the president of CFA Society Ottawa, and it's my pleasure to host today's event, so thank you for joining us. Our objective over the summer has been to offer a bi-weekly webinar covering an interesting investment theme reflective of the current environment to allow our members and other attendees an opportunity to think through their current and future investment decisions by accessing insights from talented leaders from global investment institutions. Our first webinar was held on July 14th and covered emerging market equities with BlackRock, followed by our second event held on August 4th with Acadian, which focused on value investing. We hope you were able to join us live, but if not, you will find a link on our website to watch the recorded webinars. We will continue to offer regular virtual events over the coming weeks, so stay tuned for an announcement on our next event, which will be on global equity versus US equities and equity across the market cap spectrum with B Finance. Today we are joined with Nora Creedon, Jeffrey Fine, and Peter Weidman from Goldman Sachs. We'll be discussing private and public real estate investing. Their bios are available on our website and at the link for registration. I had the pleasure of listening to them speak recently on a Goldman webinar and thought they'd be well positioned to share their insights with our attendees here today. This is a live event and they'll be speaking for approximately 30 to 35 minutes. All attendees will be muted, but we'd really encourage you to submit questions directly through the Q&A button on the bottom of your screen. After the completion of their remarks, I'll be asking them a few of my own questions, and I'll be gathering and posing the best questions from the audience. I hope you will enjoy this event. We'd really appreciate you completing the survey, which will be emailed to you after the event, so we can enhance this experience for our future webinars. So we are here today to discuss real estate investing. It seems fitting that I'm speaking today from my home instead of the office, which I could not have imagined doing before the pandemic began, let alone using Zoom with video on a very regular basis. We will be discussing the many changes that have already taken place and assess what the future holds for what seems like an asset class significantly disrupted from this pandemic. Noteworthy changes include, of course, working from home and the acceleration of online shopping, which has greatly impacted the valuation of many retail properties. An interesting stat that I came across was in the US, it took 10 years for e-commerce to grow from 5% of retail sales to 15%. But during the pandemic, it took just 8 weeks to go from 15% to over 25%. So what does the future hold for public and private real estate investing? Without further ado, Nora, Jeff, and Peter, welcome to our summer webinar series, and thank you for being here with us. You may now proceed.
Great, thanks, Sean. This is Nora Creedon speaking. I head up our global listed real estate and infrastructure strategies within Goldman Sachs Asset Management. And as Sean mentioned, we are fortunate at Goldman Sachs to have real estate expertise across both the public and private space, and in fact across both equity and credit when it comes to the private space. So we have lots of perspectives to talk through to get at some of those themes that Sean mentioned in his introduction. So I'm going to speak for about 10 minutes or so, and then I'll turn it over to my colleagues Jeff and Peter, and then we'll open it up to Q&A. So I have a few slides just to help guide our conversation. I promise not to bore everyone in slides on an August afternoon, but if we could go to the next slide here just to kick off. So this is just to sort of frame for you all what happened for those of you that are not familiar or looking at real estate on a day-to-day basis. Clearly, we were very much in the eye of the storm when it came to this pandemic and the shutdowns that occurred starting in March of this year. And of course, the fact that that happened globally was a pretty unusual circumstance. Usually in real estate, we think of it as being quite a local business, but this was something that really affected every corner of the world. And so at the worst of the downturn towards the end of March, real estate in the listed markets was down about 45%, and that is the most dramatic decline in equity prices in as short a time as that occurred that we've ever seen. So in the financial crisis, equity prices declined more, but over a much longer period of time. And then starting in the end of March, we had the Federal Reserve come in and backstop a number of markets that are very important to the real estate markets and the financing markets. That began a turnaround that has continued through August. These numbers you see here as of the end of the second quarter, they are actually a little bit better as of today. But really the purpose of this chart is to show you just the very wide level of dispersion we've seen between the various subsectors. So on the one end, you've got technology-related real estate. Those are data centers, cell phone towers that have performed really well through the pandemic. We were chatting prior to the start of this conversation about things like Zoom and doing all of our conversations on video. You know, Zoom is a company that had about 10 million daily users back in December, and today has more than 300 million daily users. And Zoom needs to connect through data centers and through cloud connections in order to make these conversations happen. And so that's been really positive for that end of the real estate spectrum. On the other end, hotels, the retail space have been really, really damaged as we go through this. And we'll talk a little bit about why that is and what the future might hold in the next few slides. On the bottom end of this chart just shows you where to put the US in context versus other markets. Japan's actually been the worst hit market of the major investing markets that we look at. And then relative to other indices like the equity markets broadly, you can see that on the lower right-hand side. So if we flip to the next slide, this is kind of the answer as to why those dispersions in returns have occurred. This is a look at what we think forward cash flow estimates for terms of property NOI, what they've done over the last 6 months. So what has been the change to the estimates for 2020 to 2022 relative to where those estimates were at the start of the year. And as you can see, by and large, things like data centers and technology and industrial are around about where they were. So there's some short-term impact from some tenants that maybe we're struggling a little bit, even in good sectors like industrial. But by and large, these estimates are as strong as they were when we started the year. And my guess is in some cases, they'll actually be moving up over the next 6 months or so. On the other end, lodging has really, in particular, been decimated in the public markets. The assets that are capitalized in the public markets in the lodging space are largely upper upscale luxury properties, many of them in coastal markets. And so, even though we've had some recovery happen in the hotel business, it's weekly occupancy has been improving since we bottomed back in the spring. But for the publicly traded companies, they own assets where the occupancy is still only at about 20% or so. And so it should come as no surprise why we've seen the performance that we have, because it's pretty directly correlated with these forward cash flow estimates. If we go to the next slide. So where do we sit now? What do we like? I would say that we do believe that COVID is a mark in the sand and that we are now in a new investing paradigm. Some of that is a phrase you all have probably heard, whether it's talking about equities or other, many sectors in the market. And that saying is that trends that were already in place have accelerated, and that's true, but they've accelerated such a rapid clip to the point that Sean made earlier on how much advancements we've made in e-commerce adoption, for example. By the way, not all of that even just with Amazon. Amazon had a hard time keeping up with the level of demand they were experiencing, and so it opened up a lot of opportunity for other companies to expand their e-commerce operations, whether that's Walmart, Home Depot, or Etsy, or others. And so we've had that happen in such a short period of time that it is really disruptive. It is going to cause, we think, real changes in terms of how much demand is coming into things like e-commerce oriented logistics or cloud oriented data centers. And so we do believe you have to shift your investment strategy to get more in the right themes to invest in. And so today we find ourselves, I'm going to walk through a few of these themes that we like in particular, but generally speaking, we do believe digitization and e-commerce have really accelerated many years down the path that we were already on, and it's unlikely to go back, because when people form adoptions around certain behaviors like this, we think it's unlikely those are going to change. We do like innovation cities. We liked them before, but we like them even more now because we're more afraid of the trends that could take place in some of these more coastal urban markets where a lot of the REITs, again, had spent the last decade or so putting their portfolios. We like the life science space, which we'll get into a little bit. I would make that akin to what the Washington, D.C. office market looked like after 9/11, when we started spending a lot more money fighting that particular war. This is a different war, right? It's a healthcare war. And so we're going to see a lot of investments in biotech, and that's a specialty type of building. And so where we can find interesting investments in that, we're pursuing those. And then, demographics are always a way to invest in real estate, but even more so today. And so we'll talk through a couple of those. We think, in general, the yield that's being offered in real estate is pretty attractive relative to a 50 or 60 basis point 10-year, and also other forms of fixed income investing. And we think there's never been a better market for active investing. So this is not a time to own the benchmark, but really to find yourself aligned with the right themes. If we could move to the next slide. Amy, if you don't mind moving to the next slide. Yeah, great. So, it comes up a lot. How do we think about public and private market investing? And we're going to talk a little bit about the valuations later on in the conversation, but I did want to just show you what has happened in the public markets. So this is a comparison of what's comprised in the public markets between core assets and non-core assets. We use the definition that Green Street, which is a pretty popular research shop, uses, core being apartments, retail, industrial, and office, and non-core being all those little niche sectors that have grown quite a bit over the last 20 years. And so today, this is a comparison in the public markets versus the NCREIF. It's really not a knock on the NCREIF. The NCREIF is a measure of what's happening in core income producing real estate. And so you should expect that they're invested in assets that are clearly in the core bucket, and they're not developing or doing those sorts of activities. And so it's not a knock against it, but just to give you a measure of what is happening in that market versus the public markets. Today, you've got almost 50% of the listed market that's in those non-core markets. And of course, a lot of investors in the private markets have also gotten more and more interested in these niche sectors. In fact, I think Jeff can probably touch on this, but at Goldman Sachs, a lot of our investing that's been in areas like student housing and other parts of the market that are clearly more growth oriented and more of what we call niche investing. And so our investing today, if we flash to the next slide, Amy, is really focused on finding these areas where there is innovation-driven growth that we can get on a thematic side of for the next 4 or 5 years. And so things like digital storage and towers, we think are going to have many years of growth ahead of them here as we get more and more connected devices, more and more data. And so our view on where the growth is going to compound for those companies makes us comfortable with the valuation. Life sciences, I mentioned earlier, industrial, we're very positive on in particular on the e-commerce oriented industrial space, where the average e-commerce order, let's say, if you're ordering an item, tends to take about 3 times as much space in a warehouse facility than if it was shipped to a brick and mortar retail facility. And so we think there's a lot of positive trends to invest in there. And then tech-driven office, despite the fact that we think technology companies are going to be really smart and forward-looking on how they use their office real estate, we do think they are going to continue to invest to grow. And so even in the midst of this pandemic, when it's been quite a difficult time for office leasing broadly, you may have seen things like Facebook taking 800,000 square feet in New York City. Amazon, yes, they had previously announced it, but you may have seen in the paper today, they are going to move a number of people into the former Lord & Taylor building in Midtown. And so we do believe finding places where technology is investing, whether that's in the West Coast markets or other markets, even including sub-markets within New York City, is an attractive place to be. The next slide is going to talk through some of the more demographic-driven secular growth stories we see. Again, I'm happy in the Q&A to talk through any of these that you're interested in more particulars. And there's a number of these where our private colleagues are looking at these segments as well, and so we're happy to talk through those. We can skip over this one. This is just areas where we are more concerned. So certainly retail, that's quite an obvious one. The only thing I would say on retail on the positive side is that while we have certainly advanced many years into the e-commerce trend in the last 6 months, the companies have also now really started to evolve. And so you're starting to hear more and more about owners of retail assets trying to repurpose them or think about other uses, even partnering up potentially with Amazon, for example, for distribution. And so I think we've seen the acceleration of the entire retail ecosystem, including the response from the owners. The next slide, and then I'll promise to stop, is just on the valuation. Where are we? So we tend to look at listed real estate versus any version of a fixed income yield. So you could look at a U.S. 10-year Treasury, for example. You could look at the BAA yield, whatever measure of fixed income that you want to look at. So on the top left-hand side here, you see the implied cap rate spread. So that's just the property cash flow over the value of the company, and looking at that spread relative to the BAA yield. And so right now, about 200 basis points of premium to own U.S. real estate versus that fixed income instrument. And that's a pretty attractive spread relative to history. So even though we're certainly off the bottom where we were closer to a 300 basis point type of premium, it's still, we think, very attractive. Versus the broad equity markets, of course, the S&P has recovered quite a bit, dominated by a number of technology companies that are growing rapidly. We, of course, in the real estate side, try to get ourselves in a position where we're serving the real estate needs of those rapidly growing technology companies. But the S&P at 21 times forward earnings, I don't think is viewed as cheap by many people in the market, whereas the REIT multiple at 15 or 16 times does appear pretty reasonable. Now, of course, again, going back to that original chart that shows you the dichotomy between these various subsectors, that 15 is really, it's just an average. At the extremes, there's everything from retail at 6 or 7 times earnings to technology at 28 or 29 times earnings. And then lastly, on the bottom here, sorry if it's a little bit hard to read, but this is a measure of where listed real estate trades relative to its net asset value. And again, for those of you that are not doing real estate every day, we try to mark the portfolios of the publicly traded companies to what we think they could liquidate for if we were to sell them into the private market. And what you can see is that right now, we traded about a 6 or 7% premium, we think, to what the private market value is. That's post the recovery that we've seen since April. But underneath the hood, again, very, very different numbers here, whether you're looking at the core sectors or the non-core sectors. So the non-core sectors where there is much more visible growth, stories that are pretty well understood in both the public and the private world, there's actually a premium that we think those stocks are trading at relative to where they would currently transact. And then the non-core the core sectors, so your core food groups of apartments, office, retail, those are where we can find the real discounts. They average about a 14% discount, but certainly in some areas, it could be double that. And so that's the interesting debate that we certainly talk to our colleagues, Jeff and Peter, about to get their views on where the value might be, how they see value. And again, I think the view of the private market has continued to evolve on a number of these sectors. So with that, let me turn it over to Jeff, and I will come back for questions when they're done.
Great. Thanks, Nora, and good afternoon, everyone. Thanks for having us today. As Nora said, my name is Jeff Fine. I'm a partner in our merchant banking division, real estate group. I'm joined by my partner, Peter Wiedman, who oversees our credit investing activities. And look, we wanted to spend a few minutes adding on to some of the themes that Nora just discussed, because many of them from our observation are consistent with what we've been seeing across our portfolio. Today within the merchant bank, we oversee about $48 billion of assets under management on a global basis in the US, Western Europe, and Asia and Australia. That's across real estate equities as well as credit. We're fortunate to have multiple pockets of capital that are priced for different types of risk, from core equity all the way through opportunistic equity and more senior secured financing capital through higher yield capital. And what that enables us to do is to price risk, to think about markets at moments in time, but also over a longer term trend line. And that's one of the things that I would note that's probably a little bit different about the way that we think about the world relative to what Nora just articulated, which is our view in real estate investing is over a much longer trend line. And so while we are in the midst of what has been a horrible pandemic, where there have been financial implications that everyone is very much aware of that impact our industry, our sectors, what we try to do is look through to the other side of the pandemic and not make permanent decisions about the way things are going to be going forward in the midst of things continuing to unfold. And so what are some of those important trend lines? Number one is about markets. It's about what the markets are that we believe are poised for growth in the long term. It's been a huge area of focus for us. It's been driven, interestingly, in large part by younger populations, by the workforce populations, millennials who are populating our growing companies, who want to be in places where there is an affordability component to lifestyle. And as a result, there are housing demands, corporate demands that have followed them. And it's really, as Nora alluded to, driven people, at least from a US perspective, out of certain markets like New York and Boston and Washington into places like Nashville and Austin and Denver and Seattle. And so we focused heavily on those markets. And while those industries that have driven a lot of those markets have thrived through this near-term period, we actually believe that they will continue to thrive over the long term and continue to drive those markets where taxes are lower, cost of living is much lower, and as a result, we have a very positive outlook for real estate forwards across asset categories, whether we're talking about multifamily or office. There's been a lot of narrative around the different asset classifications and what the winners are, what the losers are. It's been reflected in the public markets, as Nora mentioned. I think a lot of that has come down to this overarching view of net asset value. What are the underlying asset values, and where are stocks trading relative to those net asset values? Our view is that we still have some watching and waiting to figure that out. That there's been an enormous amount of stimulus that's been pumped into the system, as everyone knows. We think it has kept us from suffering a far more severe financial crisis, but it's also propped up things like collections across multifamily, across office, and time will tell the way in which the unemployment rates and the impacts of the health costs will manifest themselves in the markets and to the underlying collateral. And so there's a lag in our markets that we are waiting to see exactly how that's going to play out. But again, we follow the long-term trend lines. We try not to get too caught up in this idea that you'll hear espoused by many people that office as we know it has forever changed, that everybody now wants to work from home, and that the return to office is something that is going to fundamentally change the way that we think about space. To some extent, we think that will be the case, but we also think people are going to want to go back to work, and people like being in a shared space where they collaborate and work with colleagues. And this conversion of living and working and schooling is something that we've all had to endure and suffer, and there have been silver linings to a lot of it, but that ultimately there will be some reversion back to the normal that we once knew, probably with some slight modifications that we're still waiting to see how they play out. We are focused on a lot of the newer, what I'll call sort of in vogue asset categories that Nora mentioned, that have long been sort of real estate adjacent. So things like data centers, things like life sciences, which again has been sort of a subset of the office market, but which is obviously getting a lot of attention right now for all the obvious reasons. And those are, generally speaking, undersupplied relative to the demand from investors to invest in those types of assets. And so we are spending a lot of time in those sectors right now because they're timely and relevant, but we're also trying to envision a more normalized environment and to think through the way in which that supply capacity gets absorbed over time. And how liquid those markets remain over time as institutional equity again begins to find more traditional asset classes when they come back into favor again. The last thing that I'll mention, and then I'll turn it over to Peter because I think it's the right segue, is we're hyper focused right now on capital flows and thinking about global capital around the world. In a 70 basis point 10-year environment today, the risk premium that investors demand, coupled with what dollar exchange rates look like here, and what local currency considerations look like for US dollar investors investing in other parts of the world, are all factors that are going to impact flow of funds. And the way that those flows of funds impact institutional demand and correspondingly how that impacts things like cap rates and trading values going forward is something that we're watching very closely, working with our economists on and studying. And look, we think there's going to be a continued volatile period ahead. It's a personal view. The firm has its economist views that are readily available, but I think we are proceeding carefully and cautiously. We have a big portfolio that we want to make sure we protect, and we want to make sure that investment decisions we're making today will stand for the near term and the long term with downside protection and good high quality assets in good locations and good markets. And where we can realize outsized growth going forward because of some of the secular tailwinds that we're following closely. So with that, I'll pause and turn it over to Peter to pick up where I left off.
Thanks, Jeff. And thanks everyone for joining. The problem with going third out of three is that most of the material is already covered, and they took a long time to do it. So I'll try to keep it short and sweet and wrap it up so we can get back to questions and what you guys want to talk about. But talking a little bit about the liquidity in the capital markets, kind of two general themes is, one, it dried up very quickly at the end of March. The real estate markets generally being a little more illiquid on the lending side and a little more opaque than on the corporate side. So what you saw were lenders, very quickly turning off the spigot and not making any loans. And it's only recently started to come back. And then secondly, those lenders focusing on their existing portfolios, whether it was servicers focusing on the securitized portfolios or balance sheet lenders like banks and insurance companies kind of focusing all their efforts inward to work through their existing problems. There really was no lending to be found at the end of March into April and May. And even as the corporate credit markets were reopening very, very aggressively, that's been much more measured on the real estate side. For the most part, we've seen lenders willing to work with their borrowers. We haven't seen a lot of aggressive predatory lending. Again, these loans don't really trade as freely or aren't as liquid or available as you would see on the corporate side. So you don't have a lot of the distressed lenders coming in, at least not yet. That might change over time, but for now, lenders are basically agreeing to accrue interest where necessary, agreeing to work with borrowers on payment plans, and willing to extend maturity dates. And that's kind of leading to a pretty quiet time in the private real estate markets now, which, equity or credit, it all works very closely together. So if lenders aren't forcing their borrowers to refi and buyers aren't really transacting on new deals, then you just don't see a lot of activity. And the places where we are seeing activity, it's a little bit of a tale of two cities on the credit side, to what Nora and Jeff were saying. Right now, everyone wants to buy multifamily, everyone wants to buy industrial, everyone wants to develop industrial, everyone wants to lease their building to Amazon. And the few lenders that are lending now, they want to do the exact same thing. It's the tale of two cities where all of those asset classes, not only do they have activity on the equity side, but all the lenders that want to lend, whether it's CMBS or life insurance companies, which are probably the two most active right now in industrial, and then add in the agencies, Fannie and Freddie on the multifamily side, that pricing on a loan is pretty much where it was before COVID. Equity prices are at or where they, or maybe even more aggressive than where they were pre-COVID within those very, very small group of attractive assets. And then if you go the opposite direction, nobody wants to lend on hotels. Nobody wants to lend on retail. There's almost no liquidity in that system. And then you have all the assets in the middle, the office buildings, where if they're fully leased and they have credit tenants, you can find some lenders to touch and want to make loans. But there's no new office development. If you have an older building or a lower quality tenant roster, much, much harder to find financing. So we'll start to see this continue to develop, I think. As I said, right now it still feels a little bit quiet. I think you really need the lenders to start losing patience, or you need the borrowers to start running out of money. One of those two things are going to be a catalyst to a little bit more activity in the market and a little bit more new investing on the private side. So let me pause there, and we'll see if anyone has any questions.
Great. Thank you very much, Nora, Jeff, and Peter. I think that was very insightful and hopefully valuable to our attendees here today. So now we're going to go to a live Q&A. So I see a number of questions already in there, but if you haven't or you are interested in submitting a question, please do so now. So I think we're going to start with a question to pose for you, Jeff, as it relates to office real estate. You touched on it a little bit, but I kind of want to dig in and get a sense of what you're actually seeing on the ground and what's happening to some of these commercial real estate office properties that you have when it comes to square footage per person versus some moving remotely or retrofitting lobbies or atriums. How is that dynamic changing as we accommodate this new abnormal?
Sure. Look, it's a great question. It's at the top of everyone's list of what to talk about in real estate today. I'll start with suburban office because it's the thing that a lot of people from a sort of counter normal perspective are sort of saying, are people going to gravitate away from cities, and are people going to move back out into the suburbs? And as a result, is suburban office going to benefit? And getting back to what we talked about earlier in terms of where do young people want to be, ultimately our belief is they still want to be in cities. And while cities are going to have different sets of challenges going forward, ultimately, this feels like a little bit of a moment in time where people are sort of retreating back to, whatever is near home. But ultimately, as soon as there is some sort of solution, people are going to want to be together in cities again. In terms of how space is configured, we talk a lot about de-densification, right? It was densification for a while, everybody moving into tighter quarters and shared workspaces and efficient floor plates that could accommodate, that densification were the thing that was very important. Now we've moved back a little bit in terms of school of thought to the opposite direction. Where can we create a little bit more space, a little bit more distance? And a lot of landlords have gone to great measures over the course of the spring and the summer to retrofit a lot of their space to be able to accommodate what we think of as a safer work environment. I think we're going to see that for the foreseeable future. How it impacts on a permanent basis the value of underlying real estate and the leasability of real estate, I think time will tell. But our general view is that there will be a reversion back to some semblance of normal with modifications to the way that space is designed, at least in the near term.
Thanks, Jeff. Next question I have is for Nora. If we can talk a little bit about retail and e-commerce. You mentioned, actually, I think all three of you mentioned Amazon at some point. There was an article, I think, last week about Simon Property Group, which is the largest U.S. retail owner, potentially repositioning some JCPenney and Sears stores into fulfillment centers. Is that a trend that you kind of expect to grow? And what's going to happen to the rest of the underutilized retail malls?
Oh, well, if I had the answer to the latter question, I don't know. But yeah, look, I think for a number of years, owners of retail real estate have been trying to figure out how to repurpose, densify, create more value-added real estate, and in places where the retail asset is really strong, like you mentioned Simon Property Group, so we'll take one of their assets like Phipps Plaza. They were able in Atlanta, Buckhead, they're able to add hotels and residential to that. That's clearly not the case for all retail assets, right? And so I think that it's not just happening at Simon, it's happening General Growth Properties, which is owned by Brookfield. They've been supposedly trying to repurpose a number of those malls into all kinds of things I hadn't even thought of, like senior living potentially and other things. So if the asset is reasonably well located, a lot of it was built to be the town center, even in the suburban locations that it was built in, then I think there's going to be a way to find something to do with that real estate. If not, it's just much more difficult. And I think to Peter's point earlier, right now the equity market is very, very negative on retail real estate. So it trades at very, very low multiples of cash flow, very high implied cap rates. The credit markets have still been pretty friendly, at least in the public markets, to retail. So Simon issued on a blended basis about $3 billion of notes that averaged 20 years of duration for under 3%. And so, they're able to raise a lot of capital and they have a long runway to try and invest that capital and revitalize the real estate if they can. The particular deal you mentioned that was in the paper was, for them to partner with quote unquote the devil, right? Amazon is their public enemy number one. And whether they would do that, I don't know. They've not commented on that publicly, but the idea would be to use some of those very large department store boxes as a form of distribution, and in a sense, as I mentioned, if it's well located, it could very well be last mile distribution. And the thing I would just mention for those of you that don't traffic in real estate every day, those department stores, which are clearly have been struggling for more than a decade, they pay very, very little in rent. They pay $4 a foot or less, let's say, in rent. And so you don't need huge economics to make a deal work with somebody like Amazon, but clearly there's a lot that goes into that in terms of how you would have to reconfigure, the parking, the traffic. Do people still want to go, to the mall and see huge trailers, right, with boxes coming out of them? The mall is struggling enough without that. And I think, the other tenants that the retail guys have been putting in, whether it was movie theaters or restaurants, more and more experiential tenants have been uniquely hurt in this crisis. And so there's quite a bit of space that may need to be redeveloped in that space.
Comes to leverage in the system. Can you frame it, your perspective now, the quantum of leverage, how much LTVs are on a typical property in context of 2008, and maybe the providers and sourcing of that capital? As an institutional investor, I'm seeing a lot more real estate debt funds that weren't around 7 or 8 years ago, and that's kind of taken off. So can you kind of frame the current environment relative to what was going on pre and during GFC?
Sure. Yeah, I think the biggest change we've seen over the past 10 years relative to prior to the financial crisis was a shift away from CMBS. CMBS had really grown to dominate the market and had gotten pretty flexible in terms of what they were willing to do pre-financial crisis. Leverage levels had gotten very, very high. 85, 90% loan to value financing was not uncommon at very cheap rates, and the CMBS market was originating hundreds of billions of dollars of debt per year. Post-financial crisis, the market's really remade itself, and volumes have recovered a little bit. Historically over the past few years, anywhere between 70 and $100 billion a year. Not only has the demand for bond buyers been much less, but the demand for borrowers to want to borrow CMBS is much less. There's still certain cases where it's the cheapest form of capital, and certain borrowers are willing to make that trade-off, but it's also the least flexible form of capital, and there's a lot of borrowers that are very reluctant to borrow in the CMBS markets because of the constraints that are placed on servicers in how they have to manage loans if things don't go according to plan, the restrictions they have to follow in terms of trying to release or utilize reserves. You just have a lot less flexibility because they're pre-wired loan documents and no ability to really change. So you're trying to guess at what the world's going to look like and what the loan's going to look like and what the property's going to look like 2, 3, 5, 7 years in the future, as opposed to a balance sheet lender, whether that's an insurance company or a bank or a debt fund, who really has the ability to control what they want to do as they asset manage the loan. So we've seen a lot of borrowers willing to or wanting to move in that direction, even if the cost is a little more expensive. And really, over the recent few years, the cost differential just wasn't that big. So you saw the lack of flexibility really hurting the CMBS market as life insurance companies, really wanted to grow their real estate books, in a world of no yield or very limited yield over the past few years. That's been a big area of growth. Life insurance companies that were traditionally long-term fixed rate lenders, moving much more aggressively into shorter term floating rate loans, away from their traditional asset liability, long-term matching. Banks, both large money center banks as well as smaller regional banks, local banks moving aggressively into increasing their real estate books. The liquidity was really there across the board, and what that led to, as everyone was competing for these loans, was significant pressure on coupons and yields and structure over the past few years. Relative to the financial crisis, we didn't see as much pressure on the level of leverage, and I think that's a good thing where we sit today. You didn't see a lot of those 85, 90% type loans. What we've been seeing for the past few years was a lot of 65, 70% type loans, and then more aggressive borrowers pushing into maybe 75 or 80%. But that's the majority of where we saw the loan to values maxing out. And I think borrowers actually learned their lesson. This wasn't just borrowers wanting more money and lenders not willing to give it, although there was definitely a little more discipline on the lending side. You also saw borrowers who suffered through the last financial crisis realizing that as long as you have moderate leverage, and you can hold through the cycle, your chances of recovery and holding on to the assets is greatly improved. So it was really kind of a match on both sides. And then, the last part of your question, we've definitely seen a very large rise in the debt funds and what those debt funds are lending against. We run a $6.5 billion debt fund right now. It's the third in our series of funds that we started post-financial crisis, the first in 2009. And that's been a great business for us for some of the reasons that I talked about, in terms of the flexibility that we can provide to our borrowers, a real acceptance, I think, from institutional investors as to the longevity of real estate credit and where it fits into an investor's portfolio. So again, a real match between what borrowers wanted and the types of returns that investors were seeking. And that's come through private funds such as ours, as well as publicly traded mortgage REITs, which have proliferated. Most large private equity firms, Starwood, Blackstone, TPG, KKR, all sponsored REITs. And they started becoming very aggressive in lending over the past few years, tens of billions of dollars a year. Again, a good match between flexible capital the borrowers wanted, and then generating returns in the public markets and generating yield in the public markets that investors wanted. And Nora could probably speak, from the investor side, a little bit better than I could about what was driving, the capital raising there. But from a competitive standpoint, what really continued to drive their yields was the use of very aggressive financing, warehouse financing, repo lines, which now that the market has turned, caused a lot of very early pain. It was, the classic mismatch of long-term assets and short-term liabilities. And when those repo lines had margin calls or mark-to-market issues, we saw a good amount of distress within those publicly traded mortgage REITs, stock prices trading off 40 to 50%, and in some cases significantly more at the bottom, 60, 70, 80%. So I think the form of capital, and the nature of real estate lending being an illiquid asset, bears remembering as to what can happen if you have that mismatch of assets and liabilities, and making sure that you're managing the balance sheet of these debt fund lenders as prudently as possible. And investors are asking the right questions as to how these funds or REITs are structuring themselves.
Thanks, Peter. When you mentioned liability asset mismatch, my first thought is WeWork, which is obviously not in the news as much now as it once was. There's a couple questions from the audience that relate to the NAVs on REITs. So my question for Nora, to maybe summarize and combine or attempt to summarize, question from John Harvey and Andrew Urquhart, is about the discount and premium to NAV. And what are the drivers of some of those, which I think you've shown on slide 8? And where is Goldman Sachs positioning? Are you more active on those that perhaps have been written up in value, that the ones at premium, or are you seeing the opportunity at the ones that are trading below NAV?
Yeah. So, NAV investing is an art, not a science, right? There's no price unless a company is actually taken out, by private capital. And so we're not so much NAV investors, I would say, versus our peers. What we're really looking to do is find companies that have very visible growth. We want the highest growth possible that can compound for the longest time possible with the least required CapEx. And we're usually willing to pay a little premium to do that, again, because of the compounding nature of that growth. And so there's a lot of sectors in here that will show as a premium to NAV as per Green Street that I would disagree with, because I think they're, in many cases, they don't have a lot of transaction data to use. And we know that a number of private capital managers are very eager to get into those spaces, would be happy to transact at cap rates, in the fours, for instance, given how low borrowing costs are. And again, given how visible the growth is in some of those sectors. And so, I don't know how much credence to put on it. And on the flip side, I guess I also worry whether those discounts to NAV are real in sectors like, like office or retail. Retail still shows as a big discount to NAV, but I'm not sure, if we believe in those NAVs. I think, office, to Jeff's point earlier, is in a moment that it's just by nature, people want to predict things very much into the future. And, we could, at the moment, office feels quite challenged because partly because none of us are in our office. And because companies are thinking about their real estate footprint differently, and they're looking for higher value locations and all of those things, which, on the one hand, it means we can pivot to those markets and find those markets that companies may go to. But I do think even in a market like New York, I tend to agree with Jeff. People will come back, particularly if, a vaccine is created, which is is a very binary type of event that is likely to happen in the next 12 months. And when you look at where those stocks trade relative to their net asset value, they're trading, implied cap rates close to 10%. They're trading at implied values per square foot of about $400. So think about what that implies if you do the reverse math for where rents are going. I think that's pretty harsh. And so I do think there's opportunities to do that. But your classic case of, close your eyes, buy a stock trading at a discount to NAV because it's got poor management or a balance sheet that's sort of messed up. I don't see as many of those opportunities presenting themselves. And so I guess the long answer to your question is we are actually quite happy to buy things that trade above Green Street's estimate of NAV because our view of the asset value is different.
And you touched on cap rates a little bit there. We've got a number of questions on cap rates. Maybe we can start high level if we can dissect a cap rate a little bit. If the starting point of a cap rate is kind of interest rates, and those have come way down, or at least almost pretty much a full percent this year, and then there's a risk premium. Can you talk about what's going on with that risk premium? What is, obviously cap rates are subject to each sector and asset, but just in general, what trends you're seeing and what's the major driver of that? Is the risk premium portion going up because there's more uncertainty around the cash flows? Just how are you generally evaluating this environment from a cap rate perspective?
Yeah. So the risk-free rate, has declined by quite a bit, and yet the risk premium has expanded by quite a bit. Why? Because we live in a very uncertain world, and who among us, on this call wouldn't underwrite more risk into your forward cash flow estimates for anything today, right? The world just feels more uncertain. I would say, when you look at those cap rates, those are implied cap rates that are actually reflect where the stocks have traded to, where the enterprise value has gone to for the various REIT sectors over what we estimate the property cash flow is. We could be wrong about what the property cash flow is. That could be an incorrect estimate, but that's what we think, the cap rates are. Jeff and Peter would be much more equipped to tell you what cap rates they're actually seeing in the market today, going through sectors where there are trades happening in multifamily, industrial, and some other areas. They could tell you more real time what they are. Those are what are implied. I would say, cap rates and their relationship with interest rates are really interesting, right? Because the theory that you start with the risk-free rate and then build in what your estimate of risk premium is and adjust that risk premium dependent on the sector and the asset and its balance sheet, its management, et cetera, doesn't always work that way. One of the interesting things in that chart, when you look back to the financial crisis, for instance, in 2007, where publicly traded real estate was trading at cap rates inside the 10-year, so inside the risk-free rate, meaning that we thought there was going to be so much growth that would subsume that. And so the market is not always doing very rational things. I would say on average today, with the publicly traded real estate stocks trading at cap rates of 6%, 7%, those are pretty attractive values. And if you believe in the sustainability of the income, then they're going to be very good buys. And so any way you end up looking at that relationship versus a risk-free rate versus a bond yield that embeds more risk versus a dividend yield, whatever you're looking at, I do think they're pretty attractive today.
Thanks. And maybe another question, this could be either for Peter or Nora. There's a question from our audience as it relates to credit ratings of REITs. Are a number of these entities getting downgraded? What's going on in that space right now?
I can kick it off. Yeah, no, as I mentioned earlier, in the unsecured market in particular, REITs have issued over $40 billion this year. So if we keep up this pace, we're on track for a record year of issuance in the unsecured market. And so the rating agencies have been very supportive of looking through what's happened in the pandemic, and rates having declined to where they are, even if spreads are a little bit higher, the all-in cost to borrow is extremely low. So it's going to be absolutely a tailwind for earnings growth for the next year or two. In the case of the most troubled assets in the hotel space, by and large, those companies have gone to their lenders. They've gotten waivers on their covenants. They've even gotten the ability to accordion up their revolvers, their bank debt, in order to create acquisition capacity if there's assets that they end up wanting to buy. So in general, the credit markets have been really favorable. I would say the only exception is the example that Peter walked through of the mortgage REITs, which have been, I mean, boy, we need another hour to go through what happened there because it was so fascinating, but they were in many cases very dependent. The ones that blew up were very dependent on the repo market in particular. And when it comes to valuing private loans, I'm not in that business, but if I was, I imagine Peter and I could have a reasonable conversation about where to mark a given private loan. We could talk about it. We may have a difference in the bid ask, but we could have a conversation about it. in some cases, these companies the mortgage REITs bought securities because they, had raised capital. They didn't have sufficient time to get that capital invested in a loan. And so in order to maintain their dividend yields, they bought securities, and securities are just a price on the screen, right? And so as the price of those securities declined very rapidly over the course of February and March, at the same time that their repo lines, which again, that's just how it works, they come up every day. So that combination was extremely challenging. And so that's a sector where I think you could see reduced capital being made available, and that flowing to other parts, of the credit investing world outside of mortgage REITs.
Peter, did you want to add anything to that?
I do not have anything to add to that. That was the perfect answer.
Okay. Jeff, you touched on urbanization a little bit from an office perspective. Obviously, the last couple decades, there's been a push for residential urbanization coming into the big cities everywhere around the world. Hearing some, word out there, and maybe it's accurate, maybe it's not, but potential for de-urbanization in residential real estate. If people maybe want more space, and New York City, moving outside of New York City to get more property. Can you comment on your thoughts on if you see that as a trend that's likely to be sustained?
The de-urbanization trend actually isn't one that we've been super focused on. I would say there's been a little bit of push in kind of concentric circles around major MSAs, but certainly not a retreat back to truly suburban or rural parts of the country. Notwithstanding a lot of young people that are at home living with parents in the Midwest or wherever they hail from right now. But the trend, and Nora touched on this in her original opening, there has certainly been a continued trend, starting with the financial crisis, away from home ownership. I think that young people tend to be a little bit more transient, which has actually been very helpful as an investor in the multifamily space, because it's created a real demand for rental, more transient, shorter term housing. And one of the trends that's actually very interesting that we're hearing a lot about today, and that we're having discussions about, is this convergence of the lodging business with residential, where this idea of, I want to be in an apartment building where I rent my product, but I can be there for as short or long a period of time as I want to be there. And I want the services and amenities that I typically receive from staying in a hotel, whether it's a short-term stay or an extended stay. Is sort of a new industry that we're seeing crop up among existing lodging operators, and being entertained by multifamily developers and operators who are looking to differentiate. So that's one space where we think there is likely growth. Again, it's not really a move outside of cities for more space. It's just a way of living differently in the places where we've seen that growth historically. And then single family rental is another space that we think has sort of grown up and institutionalized, sort of came about on the heels of the financial crisis. But there are real companies that are out there, and as home prices fall, there's more and more demand for people that want to rent that product, and it's become more and more institutional.
So the question,
I think in general, the idea, the suburbanization is probably more of a short-term trend than a long-term trend. I think, until there's a vaccine and, the world's different. Yes, people are moving out of New York, people are moving out of San Francisco. People want more space. People don't want to be on mass transit. But at least, personally, I think the trends that have led to the urbanization and what people want and how they want to live. Once we get into a world after a vaccine and or a therapy, I think, over the long term, you'll see continuing of the trends that we were seeing beforehand.
Okay, thanks for that, Peter. I have a question for each of you. I want to get a sense of what the market is like for fundraising from institutional capital right now. Are plans actively considering allocating to each of your areas of expertise at this point? Or are they pausing? Maybe if you can each share, maybe we'll start with you, Nora, if you want to share your thoughts on what you're seeing from the REIT side, and then we'll go to Jeff and Peter.
Yeah, I would say there is quite a bit of interest, and we spent a lot of time in the last few months with institutional investors from everybody that you can really think of. Let me leave it at that, going all the way up to some of the largest sovereign wealth funds in the world, because of three things. One was a massive price dislocation, which made it potentially interesting to invest in the public markets. The second is yield, right? We all know just how difficult it is to to get real yield in the world. And so I think across the spectrum of real assets, they look attractive on that measure. And thirdly, it's this impact of disruption that makes people want to find active managers, concentrated managers. And so I would say we see quite a bit of institutional interest in the asset class today, more than we've seen in the last 5 years for sure.
I agree with all those points and all three of those points, but I would probably focus on yield. I mean, I think so many of our conversations these days are driven with yield, right? Where in the world can you get yield? And there's lots of different ways to manifest it and take a view on that thesis and get the yield you want. You can do it in the public markets. Depending upon your risk tolerance, you can do it in the real estate equity markets. You can do it in the real estate credit markets, but there's very few places where you can generate real yield these days. And a lot of our investor conversations are being driven by the desire to own a real asset with downside protection and a current yield.
Yeah, look, Sean, the only other thing that I would add to that we're hearing is there is major consolidation happening within the space. The bigger managers are getting bigger. They're offering more diversified products. The smaller, niche-y focused investors, investment managers are generally falling by the wayside as institutional capital is looking to move more in the hands of fewer managers. And so, part of where we've been spending time with a lot of our clients across the firm is trying to figure out how we can provide a wholesale solution across different risk categories, different types of assets, from real estate to credit to corporate investing and growth. And we're seeing a lot of our sort of bulge bracket peers doing the same thing, whereas sort of the one-off opportunistic real estate fund operator who only does one specific thing in a particular region, the view from institutional capital has been that they want somebody with a much wider view and a broader sense of how to price risk in the world today.
Right. We are running short on time, so I'm going to pose the last question from our audience, to maybe reframe a little bit from Taylor's survey. Maybe if each of you can share your thoughts, 10 years out, which sector or segment of real estate are you most bullish on? So we'll start with Nora.
It's hard not to pick technology-related real estate, right? Just given the growth and the amount of data that's being produced, and then think about in the next 5 years, how much more interconnected devices we're going to have, whether it's your car to your clients, et cetera, and all those things need to talk to one another, and they need to have a network that supports the communication of those devices. And so it's really bullish for data centers and cell phone tower companies, and you have the potential for more entrance in that space when you see what Dish is doing. But if I pick something that's just not super obvious, our biggest overweight of those kind of growthier sectors right now is actually in the manufactured housing space. We think the demographics for that business are really positive, and you're going to have a nice cyclical recovery in the RV business as well. And we do think RVs are something that kind of came out of nowhere during this pandemic as a good alternative to normal vacationing. And once people have sunk the cost in them, they're likely to continue using them. So I'll pick that as my non-obvious answer.
That's a good one. Jeff?
I'll answer a little bit differently, which is my view is that it's going to be more market driven. And I think what's going to be really interesting to watch over the near to medium term is the intersection of the political landscape and the business environment. And there are going to be cities and states that get it right and others that get it really wrong. And I think finding the balance of making cities places where young people want to be, where people want to be, where it's affordable, where the tax regime is business friendly, where they're attracting companies to be, over time, those markets will grow in every way, shape, and form. The multifamily will be worth more. The office buildings will be worth more. And the markets that get it wrong, that swing too far in either direction, I think are going to suffer disproportionately unless they can figure out some way to course correct.
And Peter, if you want to close us out.
Yet again, I get to go last. So I'll use that spot then to try to be a little bit provocative and pick hotels, which I think if you can find the right entry point, and there is no entry point right now because nothing is really trading yet. But if you can pick the right entry point, I don't think that you're going to see a fundamental shift in people's desire to travel and stay in hotels. Again, it'll be very nuanced by what's the market and what's the location and what's the quality type. But if you think about the idea that there were trends from before COVID that are going to accelerate afterwards, the desire of people to travel and be mobile, and of millennials to have experiences, and boomers to spend their savings, I think that over the long term, I would be a big believer in hotels as a little bit of a contrarian play to all of the negative publicity that they're having right now.
I did actually want to touch base on Airbnb, but we ran out of time here. So I want to thank you, Nora, Jeff, Peter, for presenting today. I also want to thank Amy Brown for coordinating, and of course, Goldman Sachs for their support of our society. Thank you to all attendees for being here, and we hope this was a helpful event. Please do complete the emailed survey that will go out so that we can improve for next time. And on behalf of CFA Society Ottawa, thank you all for joining us, and stay well.
Thanks, Sean.
Thanks.